All right, now we are going to revise IFRS 16 leases. Again, it is an important standard for the SPR exam. So I'm not going to discuss the background of it, that why it has converted into IFRS 16. Previously, that was IAS 17. So you can find that thing in my detailed lecture. Now I'm going to focus on the accounting treatment of IFRS 16, which is the new treatment which is applicable as well. So remember one thing, that within IFRS 16, we have two new treatments and one treatment is the same. Is that same treatment is coming from the IAS 17, the previous version of it. The new treatments are the two treatments. The first was the accounting for lessee. It is a new accounting for the lessee. A totally changed thing, because in the previous standard, we used to have the bifurcation of the operating lease and the finance lease. So that is now ended, and there's a completely new accounting for the lessee, in which there's no discussion of the operating lease and the finance lease, and the lessee is going to record the right of use asset. We'll be discussing that in a while. Another new treatment is the sale and lease back. And then the treatment which is the same from IFRS IAS 17 is the treatment for the lessor. So that is the same. We are going to discuss that thing as well. So lease is actually a relationship between the lessor and the lessee. So one is giving the asset on the lease, the other is taking the asset on the lease. One is receiving the payment, which is the lessor, other is making the payment, which is the lessee. And in exchange for the asset, the lessor is getting the payment, the lessee is getting the right of use asset. So lessor is providing the lessee the right of use asset, the right to use that asset simply. And the lessee is making payments to the lessor, which is known as the consideration. So it's a relationship between the lessor and the lessee. Now, identifying a lease. I told you that in the previous IAS 17, there was a debate for the lessee whether to account for the lease as an operating lease or the finance lease. Operating lease was just a rental arrangement, and the finance lease that the lessee used to record an asset in the finance lease. Now, the problem with that was that, for example, I'm getting an asset for 5 years. Let's assume it is an operating lease. Still, I am having the asset for those 5 years. I'll be using that asset for those 5 years. And what is the definition of the asset? What is the definition of the asset? The definition of the asset is you get the control over some resource, and that resource is going to produce economic benefits for you, and the cost of that resource can be reliably measured. So in the both operating and the finance lease, the lessee used to get the control of the asset over a certain number of years. And the lessee was using the asset to generate the economic benefit. And the cost can be reliably measured. So it meets the definition of the asset. So why they were recording that thing as an expense in the operating lease? That was the discussion over there. So they actually demolished the previous treatment, because that was not adhering to the definition of the asset. So they changed that treatment, and now there's a completely new treatment in which you just need to see whether it is a contract which contain a lease, or it is simply a contract for service. In the previous arrangement, you were looking whether it's an operating lease or the finance lease. Now that thing has demolished. Now you need to see whether it is a lease contract or a contract for service. So if it satisfies the definition of the lease, then the lessee is going to record the right of use asset. Right of use asset, that means right to use an asset, and credit lease obligations, the obligation to make the payments over the lease period. Now, what is the criteria? The standard says a contract contains a lease if it conveys the right to control the use of an identified asset By identified asset, we mean that asset should be specifically mentioned within the contract. So the right to control, now right to control means that the lessee has all the economic benefits. Lessee has the right to enjoy all the economic benefits, and the lessee will decide how to use that asset. So if there is a right to control, that means right to all the economic benefits and right to use that asset as the lessee wishes to do so, then that means they have the right to control an identified asset, and it satisfies the definition of the lease. And if it is a lease contract, then the lessee should be recording the right of use asset, credit lease obligation. If it is not a lease, then it's a contract for service, which should be reported as an expense rather than an asset. So we have an example, a plain example to understand this thing. Under a contract between a local government authority and a private sector P provides L with 20 trucks to be used for refuse collection on the behalf of the L for a 6-year period. The trucks which are owned by P are specified in the contract, that means identified asset. L determines how they are used. Okay, when the trucks are not in use, they are kept at L's premises. L can use the trucks for another purpose if it chooses to do so. So that means all of these suggest that L has the complete control, right to control, because they will be having the assets on their own premises. They will be deciding when to use it, how to use it, and they can use it in other purpose as well, other than the refuse collection. So that means it's a contract for lease, and those trucks should be recorded within the lease as the right of use asset. Then again, let's understand the other thing as well, which is a contract for service. A customer has entered into a contract with the road haulier for the transportation of goods from London to Edinburgh on a specified truck. The truck is explicitly specified in the contract, which makes it an identified asset. The goods will occupy substantially all of the capacity of the truck. The contract specifies the goods to be transported on the truck and the dates of the pickup and the delivery. So that means you can only take certain goods from one place to another on a specified date and a specified time. Each operates and maintains the truck and is responsible for the safe delivery of the goods. So you see, they can take certain sort of goods at certain time and date. So that means it's actually a courier service you're getting. It's actually a delivery service you are getting from them. It's not the lease. You're not leasing a truck. You are getting a service from them to pick your goods and drop it at some time, a relevant time, and at a relevant place. So you are actually entering into the contract with them to deliver your goods, and you are not actually leasing a truck. If it was a lease, then there was an option to use the truck for other goods as well. They can use it at any time, etc., etc. But here is a contract for service, which should be reported within the statement of profit or loss rather than an asset within the statement of the financial position. Then we have the lease term. What is the lease term? So the lease term is the non-cancelable period for which the lessee has the right to use an asset. For example, 5 years, 4 years, 6 years, whatever. Together with periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Now, this is the concept of the primary and the secondary lease period. For example, you have the lease period of 5 years, which is a non-cancelable period. And then you have an option to further lease it for another 2 years. And you believe that you will be availing these 2 years. You are reasonably certain that you will be availing that extra lease period option. Now, in that case, the lease term should be 7 years, which means the non-cancelable period plus any extendable period in which you are reasonably certain to exercise that option. And then you have another thing, which is, for example, you believe that the lease period is, let's assume, 5 years, but you have an option to terminate the lease after 4 years. And you believe that you will not be extending it for another year. In that case, the lease period should be 4 years. So that means periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. So this is an example. A lease contract is for 5 years with the lease payment of 10,000 per annum. The lease contract contains a clause which allows the lessee to extend the lease for further 3 years for a lease payment of $5 per annum. You see that in this type of case, usually we are using the asset for the major part of its life. You see, in the first 5 years, we are making the payment of $10,000 per annum, and the extendable period we are just making $5 per annum, which is just a formality to keep a consideration to keep the contract alive. So in that case, the useful life should be 8 years because 5 years is the non-cancelable period plus another 3 years which you are availing that option. Why you will not be availing? It's $5 per annum. And why the lessor has given you this option? Because they cannot lease it to any other party after 5 years because you have already used it for the major part of its life. Okay, then we have the accounting for the lessee. So as I've told you that once the lease contract definition is met, the lessee is going to record the right of use. So debit right of use asset and credit goes to the lease obligations. Okay, so what are the things that should be recorded within the lease obligation? This is the credit entry thing. Fixed payments, which you're going to make. Any variable payments. Variable payments means, for example, if your market rent is based on the market percentages, and if they change, your payment will change as well. So the variable payment will arise. And similarly, the residual value guarantees, for example, residual value guarantees is the concept that you have to make sure that when you're returning the asset to the lessee, it should worth some amount, which is the decided amount. If that asset worth less than that decided amount, that means you have to pay for it. Let's assume I told them that, okay, when I'll be returning the asset after the lease period, it is going to worth, let's assume, $5,000. And then when I actually return, the worth of that asset was $3,000. Now I have to pay for further $2,000 because this usually specifies that you are supposed to take care of the asset. Now it worth less than what it should be, so that means you're not taking care of it, and now you have to pay for it. Simply. So residual value guarantees. Now the purchase options, for example, if you believe that you will be purchasing the asset from the lessor by the end of its lease period, then take that payment into consideration as well. And then termination penalties, for example, if you are terminating the lease earlier than the non-cancelable period, then take into account the termination penalties as well. So expected payments, all the expected payments, fixed payments, variable payments, residual value guarantees, purchase options, take everything into account, calculate the present value of it, and then you will get the credit entry, which is the initial value of the lease obligation. Then you have the initial value of the right of use. So you take the present value of the lease payment plus any direct cost plus any upfront payment. So that means the amount of the initial measurement of the lease liability. This is the present value, which we have calculated on the last slide. Any upfront payment, which is the advance payment, any direct cost, and the dismantling cost if you're supposed to remove that thing at the end of its useful life. So you should take, according to IFRS-16, that thing into consideration as well. Then you have an example. You can do it by yourself. Okay, then we have the subsequent measurement of the liability. So once we have recorded the liability at the present value of the lease payment, then it is going to change. How it is going to change? The finance cost will increase your liability. The payment will decrease your liability. So the format is you take the opening balance, you multiply the interest on it. Interest will be added because it increases your liability. You deduct the lease payment because it decreases your liability, and then you get the closing balance. Whenever we have the lease arrangement, we are supposed to calculate one extra year in order to split the liability between the current and non-current. The second year closing balance is your non-current liability, and the difference between these two is your current liability. And this is the payment in arrears, when you are making the payment at the end of the year. And if you're making the payment at the start in advance, then first of all, you will be deducting the payment from the opening balance. Then you multiply the interest on the subtotal. So again, doing one extra year working in order to split the liability between current and non-current. So this second year subtotal is your non-current liability, and the difference between these two is your current liability. You can do the examples yourself. And then we have the subsequent measurement of the right of use. So we know that we are going to depreciate it because it's an asset. So we are going to depreciate it. We have two things over here, sorry. If the ownership of the asset will be transferred to the lessee by the end of the lease period, then you're going to depreciate the asset over the useful life. If otherwise, then you take the shorter of, that means lower of, whatever is the lower of lease period or lease term and useful life, whatever is lower. But if, for example, the asset will be transferred to the lessee at the end of the lease period, then take the useful life. Separating components means sometimes we enter into a transaction which contains a lease and non-lease component. Let's assume you are giving a machine on the lease and you're providing the maintenance services as well. Now, giving the machine on the lease is a lease component and providing the service is a non-lease component. So the entities can choose to bifurcate those things, record the lease component separately and the non-lease component separately. So lease component will be recorded within the statement of financial position. Non-lease component will be recorded within the statement of profit loss as an expense. Because lease liability is based on the estimated figures, I've already told you. So for example, if there is an increase in any payment, then you need to reassess your liability and then accordingly change your liability figure and the asset figure. The short-term leases is 12 months or less. There's no need to capitalize that. You can expense that thing on a straight line basis. Similarly, with the low value leases, for example, tablets, computers, telephones, small items of furnitures. In that case, there is no need to capitalize it as a right of use asset. Just expense it out on the straight line basis within the statement of profit or loss. If you're entering it into a mid-year lease, then do it months by 12, interest months by 12, payment months by 12, so that you get the relevant figure. Now we have the lesser accounting. Remember one thing, that lesser accounting is somehow, you can say, opposite to the lessee accounting. And it works the same way. The finance lease and an operating lease. Now the finance lease is where the risk and rewards are transferred to the lessee. Now, when the risk and rewards are transferred to the lessee, then that means it is supposed to be an asset of the lessee, not the lessor's asset. But the lessor will be getting the payments. So when they will be getting the payments, they should record the payment receivable as an asset rather than the asset as an asset. So because they've already given the control to the lessee, so there's no point of recording the asset over here. In the operating lease, the lease that does not meet the definition of the finance lease, that means the control has not been transferred to the lessee, and still the control remains with the lessor. So how to classify a lease, whether it's a finance lease and operating lease? So you see, if the ownership is transferred to the lessee at the end of the lease period, then it's a finance lease. If the lessee is making the payment which is approximately equal to the fair value of the asset, then it's a finance lease. If the lease is for the major part of the asset life, then it's a finance lease. If the asset is the purpose-built asset specially made for the lessee, then it's a finance lease. Other than that, it is going to be an operating lease. So you see, with the finance lease initial treatment, it is exactly opposite to the lessee's treatment. So in the lessee treatment, what we were doing, that we were actually making the payments. We are making the fixed payments, variable payments. The lessor is receiving that payments. So we recorded that thing as a lease obligation because we were supposed to make that payment. And here the lessor is getting that payment. So they will be recording those payments as a receivable. And again, the same thing. The payment which they're supposed to get within 12 months should be recorded as the current asset. The payment they will be getting after 12 months should be recorded as a non-current asset. So it works the same. In the lessee's working, we were recording current liability and non-current liability because the payment which you are supposed to make within 12 months is the current liability. Now, the payment you are making within 12 months, is the payment that the lessor will be getting within 12 months. So for the lessor, it is going to be the current asset. And then operating lease is the same because the lessor still have the control of the asset. So the lessor should be recording the asset within their books, and it is not the asset of the lessee. And the lessor recognizes income on the straight line basis, the same way that income should be recorded in the period to which it relates. So every year they will be recording the income accordingly. Then we have a very important thing, sale and lease back, that if the asset has been sold and the same asset is being leased back. Now, if the asset has been sold and the same asset is being leased back, there are two scenarios. The first is the transfer is not a sale. That means the control has not been transferred. So it's simply a financing arrangement that you're keeping your asset as a collateral and then getting the payments from the lessor. In that case, the seller lessee should record a financial liability because they have taken the payments from the lessor based on that asset. The buyer lessor should record the financial asset because they will be getting the payments and the interest. So if you are selling an asset and you're not transferring the control of that asset, and you're getting the payment on that as well, that means you're keeping the asset as a security and getting the loan. So it's a financing arrangement. So you treat that thing as a loan. That means you will be recording the liability and the lessor will be recording the asset. When the transfer is a sale, for example, I have a property. I have a property which I'm going to sell. Let's assume the life of the property is 20 years. Let's assume office building. The office building has a life of 20 years. I'm going to sell it. And then I say that, okay, I'm going to sell the property and then I'm going to lease it back for 5 years because meanwhile, I'm going to construct my own building. And then once my building is constructed, then I'll move to the new building. So till that, I'll be leasing the same building for another 5 years. Now you have already sold the building. So when you have sold the building, you are going to de-recognize the asset and you will be recording the proceeds as the cash. Now you are getting the same asset on the lease for a certain number of years. Then you record the right of use and the lease obligation. The balancing figure is the disposal gain or loss, which is calculated automatically. So what is the formula to calculate the right of use in the sale and lease back? You just take the present value of the lease payments, divide by the fair value of the asset, multiply by the carrying value. This will give you the proportion that you are leasing for a certain number of years. And if the transaction is below market terms, now, obviously you are not mad that you are selling the asset below the market value. For example, the market value of the asset is, let's assume $10,000 and you are selling it for $8,000. Obviously, no one is going to do that. But if the transaction gives that evidence, that means you're making that thing as a prepayment. Like the value of the asset is $10,000 and I'm getting 8,000. Why I'll be getting the 8,000 is that the 2,000 which I'm not paying right now is actually a prepayment against the future payments. So you treat that thing as a prepayment against the future payments. If you are selling the asset above market term, now obviously no buyer is fool enough to buy the asset above the market terms. So for example, if the market value is 10,000 and they are buying it for 12,000 from you, that means they're giving you additional finance, which should be recorded as the liability. So this is all about IFRS 16.